Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of January 11th, 2026. And in this week's episode, we are going to start off a mini series deviating away from trading into investing. And so it's going to be several episodes in a row, and we are going to tackle how do you actually get started investing. And this will be quite a bit different than trading. And the target audience here is basically somebody who either has no exposure whatsoever to what investing actually is, or somebody who has just been getting started and wants to know a little bit more about it. And we're going to break it down into several bite-sized episodes that should really help you understand each different facet of all of the building blocks to an investment portfolio to help you build wealth over time. And to kick it off in this episode number 1, it is going to be just start. So there's a lot of building steps that need to come in there, but as everything that is a journey has to begin with a single step, and that single step is really just starting. I think a lot of people get too caught up in the, oh, I don't know enough, I need to learn this, that, and this, and before I get started, and then that never happens, and they never get to a point where they're comfortable to start. And so this episode is really focused on what do you have to do to just get started. And the following episodes will kind of keep filling in blanks as we go. And so it's basically to start going without knowing the complete path that you're going to take, because sometimes just getting started is the most difficult part. But before we hop into all that content, we'll give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/Sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Finally, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. And this week, like I mentioned, we're going to be kicking off that mini-series on, I'm going to call it the Investor Mini-Series. And really where this got its genesis to kind of come into fruition here, and for me to really take a look at this, is twofold. One, on my personal portfolio, I've been kind of carving out my retirement portfolio and taking a look at it as the conclusion of 2025, part of my reflection back. And one of the realizations that I had is I really felt like my portfolio is just too complex. And so I wanted to try to simplify that portfolio, consolidate a few different things. And as I started going through that, I started to realize, hey, there's a lot of content here that's probably useful for the everyday individual who wants to save for retirement, wants to save for purchase of a home, purchase of a car, anything that they want to start building wealth, but they're not quite ready to jump into that trading day in and day out, which is what we're typically focused on. And then this was combined with some of the holiday activity, and I've gotten a couple suggestions from family and friends where they wanted to learn more about things, but they just wanted to start with the basics and really more of an investment focus is where a lot of those conversations took us. And so I decided to kind of sit down and go through a bunch of thought process there and lay out kind of an episode series around this. So this investor mini series is going to be broken into 5 parts. And this is episode number 1, where we're going to titled Just Start. In episode number 2, we're going to start talking about different asset classes and risk and why that's important and why understanding what your risk tolerance is. And each of these episodes are going to be a building block that's going to build on the previous episode. So if you're pretty comfortable with one of the topics, feel free to skip it, jump to something that you're more interested in. But if you jump into something and you realize that there's some context missing, maybe go backwards to one of the episodes that you skipped, as each one will build into the subsequent ones. Then episode 3, we're going to talk about, okay, how do we start putting our money to work? So episode 1, we're just going to start squirreling away the money. Episode 2, we're going to dive into how do you understand what your risk tolerance is and what is the risk tolerance relative to what does it mean for investing. Then we're going to say, okay, how do we start putting that money to work now that we understand our risk tolerances and what that means? And then episode 4 is going to dive into how do you measure the performance, whether it's your own personal performance, your financial advisor's performance. It's always good to keep a metric on your performance as an individual, as an investor, whether or not it's you making the decisions or somebody else is making them for you. You want to be able to get a report card on that to know if you're doing things in the right way to your goals and objectives. And then lastly, in episode 5, we're going to tie all of those topics together where I'm going to jump into my retirement portfolio, how I set it up, how I decided what investments to put in there, and kind of talk through all of the previous building blocks in a practical application of how it applies to me and the portfolios that I'm going to be diving into. So before we start hopping into just getting started, there is kind of a prerequisite that you have to do a little bit of an introspection on yourself and ask yourself a question about, why do I want to invest? Why do I want to build wealth? And that is going to vary from person to person. But if you don't start with a purpose, if you don't have a reason for what you're driving towards, you're going to find that subsequent decisions are going to be difficult to make because they're going to require you to have an objective, to have a destination that you're trying to sail to have a point on the horizon that you're driving to. And so the very first question that we're going to need to focus on is, what do you want to save for? Now, there's a lot of things that people might want to save for, and that is really the question that you have to ask. You might have it for a home purchase. Maybe you want to build up wealth to put down a very low down payment on purchasing a home. Maybe you want to purchase a car. Maybe you have college expenses that you have upcoming that you want to pay for. Maybe you're just looking for some extra spending cash on the weekends. Maybe you're actually trying to build a nest egg for your retirement. And all of that stuff factors into, and it's not mutually exclusive. You don't have to choose just one and not another. You want to put down, and I would recommend writing this down so you remember it. You can focus on it. You can look at it to remind yourself, what am I doing all this for? And that's important because that's going to factor into some of the investment decisions that you're going to make. How much risk are you going to take? How much money are you going to put in there? What is the time horizon that you need to make a return on that investment? Which is kind of the secondary thing, is once you understand what you're saving for, you have to understand how far away on the time horizon is that. Is it for right now? Is it for next year? Is it for 10 years from now? Is it for 50 years from now? It really could be anything. And kind of understanding that time horizon and understanding what the savings objective is going to help guide you understand what type of investments to get in, what type of an account to hold those investments in. And so all of these are very important questions that only you can answer for yourself. Now, this episode is all about just getting started. And when it comes to just getting started, all we want to do is take a certain percent of your weekly income, your monthly income, quarterly income, whatever it is, take a regular amount of money and we're going to put it somewhere. And the first question around what are you saving for and when do you need that money goes into where are we going to put it? Because there's effectively two options that you have. You have two basic accounts that you're going to open to hold this money. It is either going to be a tax-advantaged account or a fully taxable account. Those are pretty much your only two options, and each one has its pros and cons, which is why it's important to understand what is your time horizon and what is this money going to be used for. So the first type of accounts are going to be your taxed advantage accounts. Now, these are going to be the most beneficial type of accounts to grow money without the impact of taxes. That's why they're called tax advantaged. There's several different types that have a different impact to the taxes. Now, the drawback to these is if you put money into these type of accounts, there is going to be a lot of limitations on withdrawing that money. Whereas in a taxable account, you have a lot of extra burden of taxes that you'll have to pay to hold funds and to grow funds in that account. However, there really are no limitations when it comes to withdrawals or how you're going to spend things on a fully taxable account. And that's kind of the first thing that you have to dive into. Now, in the tax advantage account, these are going to be where you've heard of things: an IRA, an individual retirement account, a 401k, an HSA, a health savings account, a Roth. You might have heard the term Roth. And so what I want to try to do is introduce you to some of these concepts. Now, we're not going to do a deep dive into it here, but this is going to give you things to think about. And you're going to reflect back on this, on what are you saving this money for? The first one are going to be tax-free contributions. So these are the type of accounts where the money that you put in is put in before taxes are applied. These are going to be your traditional IRAs or your traditional 401ks. So that means if you're going to go deposit, let's say, $4,000 a year into one of these tax-free contribution accounts, that $4,000 that you put in does not count against your income that you earned for that year. Now, all the tax advantage accounts are able to grow tax-free. So the trades that you're going to make, the investments you're going to make in there, as they have capital gains, you will never pay taxes on them in any one of these type of accounts. Where it really comes down to is whether or not you're going to be taxed on the money going in or taxed on the money coming out. The tax-free withdrawal accounts, those are the ones that have the term Roth associated in front of it. So a Roth IRA or a Roth 401k have tax-free withdrawals. So in those cases, the money going in is actually taxed. So if you put that same $4,000 into a Roth IRA, you have to pay taxes on that first. So your actual contribution would be $4,000 minus the percentage rate of your tax bracket. Now, the benefit is as you grow that money within that account over the years and you go to take it out, it comes out 100% tax-free. So if you go to withdraw, say $10,000, 10 years from now, 20 years from now, you pay zero taxes on that $10,000. So this is where you want to be able to strike a balance on where you think you are going to be on your tax rate. Is your taxes going to be lower later in life, or do you expect them to be higher? Because that might influence on whether or not you want to pay taxes on the front end or taxes on the back end. Now, very similar to what you're saving for, it doesn't have to be mutually exclusive between a tax-free contribution or a tax-free withdrawal type of account. You can actually open up both, and you can put a little bit of money into the tax incoming or taxed deposits, and you can put a little bit of money into tax-free deposits. So you can really kind of balance how you want that to pan out. Now, there's a very special type of account called a health savings account, which is the most tax-advantaged account out there possibly. Now, it's limited until you retire to medical expenses only. However, an HSA or health savings account is 100% tax-free going in, 100% tax-free as the money grows, and 100% tax-free coming out as long as it's used for a qualified medical expense. Once you reach a retirement age, you can then start using that money for retirement and just pay ordinary income tax on it. It's still tax-free if you use it for health reasons and medical expenses. But that is a special type of account where it's known as a triple tax advantaged account because it's tax-free going in, tax-free growing, and tax-free coming out. So that's about everything for the tax advantaged account. The other type of account is a fully taxable account. Now, a fully taxable account is basically a regular brokerage account. So you put after tax dollars into it, and then on your earnings and stuff inside that account, you will have to pay capital gains taxes on what you've earned when it comes time for your annual taxes. So the benefit is you can withdraw that money at any time. You can use it for anything you want. There is absolutely no restrictions on what you spend it or how you grow it. So you'll have to go reflect back on what is my time horizon? What am I saving for? If you are looking for something prior to your retirement, then you are probably looking to look into a fully taxable account, unless maybe it's for medical expenses, because that medical expenses in the tax advantaged account, this can pay for your doctor's bills, this can pay for surgeries, this can pay for over-the-counter medication, basically anything that is medical related, vision, dental, orthodontia, all of those things can be paid for out of an HSA. So if you're saving for those kind of expenses, then maybe that tax advantage account makes sense. If you're saving for your retirement, if you're saving for income after you are no longer working, then you might be wanting to look into an IRA, Roth or traditional. If you're looking to put money down for a house or for a car or for college, the chances are you are going to need that money prior to your retirement. So you should not be looking into those accounts that have restrictions on withdrawals prior to your retirement, which is going to lead you to the full brokerage account. Okay, so now we know a little bit about the type of accounts that are out there, and we've thought a little bit about what it is that we want to save for, what we want to build wealth for, and what the time horizon is of that. And so you've probably got an idea, and now you're like, hey, where do I go get this account from? And this is a lot like walking into a supermarket where there are loads and loads of choices, and you can become paralyzed with all of the different choices and become worried about picking the wrong one or one over another. So, I want to talk a little bit about the types of things that are out there and then give a recommendation on where, if you're just getting started, maybe just look at this particular area. I would break down into three separate buckets of accounts or brokers. The first one would be a full service brokerage firm. The second would be a trading brokerage firm. And the last one would be a discount brokerage firm. And some of the things that fall into each of these categories, you might have heard of some of them. So, a full service, this is going to be your Fidelity, your Charles Schwab, your Vanguard. Think of this like the supermarket that has just about everything. Maybe it doesn't particularly specialize in very niche areas. So, maybe the organic food selection is not quite as good, but the general breadth, and they do have some organic food in a supermarket, right? Versus a niche, corner market or butcher or things like that. So this is likely where a person who is starting out is going to want to zero in and focus on. And I'll loop back to this, but basically a full service brokerage has everything. They're going to have your stocks, they're going to have bonds, they're going to have treasuries, they're going to have an interface for just about everything. And so they're not necessarily going to specialize really good in any one area, but overall across the breadth of investing and savings, every single one of these guys is going to have what you need. Now, the next classification are what I would call more trading focused brokerages. Now, they're going to be very, very similar to those full service brokerages, but they're going to start specializing in the niche area of rapid trading. So they're going to focus on fast execution. They're going to focus on low margin rates. They're going to focus on how easy it is to short a stock, what the interface is, what type of things you hook into. I would think of this as more of a performance car from a vehicle that's just going to get you from point A to point B and keep you safe and comfortable along the way. This is going to start dialing into those specializations. So if you're just getting started and you're really looking to invest, I really think you can completely skip over this category because they're going to be tilted a little bit more to the active trader. Their interfaces might even be a little bit more confusing or cumbersome to the casual investor. And so I would steer you away from this entire category. These are going to be people like your E-Trades, your interactive brokers. Maybe an interest will spark and you'll want to loop back to those. So just know that this is more of a trading brokerage firm. Now, the very last one that's out there is going to be called the discount brokerage firm. So these are going to be people like your Robinhood, your Webull, your SoFi. These are going to be kind of the younger, up and coming, hip type of brokerages. And they've really come a long way in the past few years. And I don't want to completely discount them because they do have benefits. They do have very nice interfaces. They have low rates a lot of times. But because these discount brokers, since they have emerged, the full service brokerages have tried to compete with them. And so they have cut a lot of fees, they've cut a lot of things. And so while they are discount from a cost standpoint, the delta is not that high. And I would argue that you're going to, as a first time investor, really be better supported from the bigger names until you get a little bit more comfort under your belt. You can then kind of venture out into these other names. And really the differentiation might be in the research tools that they provide, the reports that they give you access to. It's not always based on the amount of money per trade because as each of these technology keeps advancing, the cost of making trades becomes less and less and less. When I first started dabbling in stock investment, I mean, it was almost $70, $50 to make a trade. Now, a lot of these full service brokerages and discount brokerages, it's free. You can buy, you can sell, and there's no fee attached to them. And so just overall, the amount of money you're going to pay in fees is really negligible these days. And so focus on the types of services that are offered there. And you will find that in the full service brokerage, their depth and breadth of the products that they're offering are going to be much wider than some of these discount brokerages. I know, for example, for a very, very long time, Robinhood would not permit you to short stock. Now, that's not something that the everyday investor is probably going to do, but that is a limitation that that platform had. And that's where I would highly recommend focusing on those full service brokers. And to be honest, I would say if you're really not sure and you don't want to take some time into researching it, go with the first two on the list, Fidelity and Charles Schwab. Either one of those guys are big name players. They've been around for a very long time. They have every single account that you can possibly want to open. It is drop dead simple to open them. And they're going to have everything that a starting off investor is going to need. So I have had an account personally on all three of those full service brokers, as well as a couple other full services that are not really around anymore that have been purchased by Charles Schwab. How you make a distinction between them, it really is hit or miss. I would steer away from Vanguard because they are a little bit more limited on some of the stuff that they offer. Charles Schwab and Fidelity are really neck and neck as far as what they offer, the interfaces that are there. So I would say just go to each of those sites, check them out, see which one jumps out to you as, wow, this feels really comfortable to me, and go with that one. It really, really doesn't matter. And with all of the technology today, it's also super easy to switch brokerage firms. I've switched multiple times. They do this whole thing where you can actually transfer your entire portfolio so you don't ever have to worry about closing positions, taking taxable impact to it. You literally lift and shift your holdings to another brokerage. There's a whole brokerage clearinghouse system that all of that goes through. It's as simple as changing your cell phone from Verizon to AT&T or to T-Mobile. You just say, hey, I want to bring my money to you, Charles Schwab. Here is my Fidelity account information. Please go get it done. You sign a couple of authorizations. 2 days later, all of your holdings, all of your funds are now in your Charles Schwab account, and they're no longer in your Fidelity account. It's very, very easy. So do not get caught up in the, oh, which one should I pick? Just look around, go one, and just get started. Now, the last thing I want to mention before we move on to talking about risk is opening these accounts are drop dead simple. If you've ever opened an online account for anything, whether or not it's a newspaper, a music service, it is as easy as punching in your username, your password, and getting an account. Most of these brokerage accounts don't even require you to fund the account at the time that you open them. They usually say that you have to put money in there within the first 30 days, and there's no minimum to that money. So a lot of times when I was evaluating different brokers, I would open up 3 accounts, put $50 in each one, and check them out. But I wouldn't, I mean, you can do that if you want, but I would say just pick one and open it. And then you have now started that. You have completed step 1. So the last topic that I want to cover in this episode 1 is about risk and risk tolerances. So we already talked about understanding your purpose, understanding your time horizon. So this is the first key important building block. The second key important building block that's going to help guide the products that you end up putting your money in is going to be your risk tolerance. So what is risk tolerance? And before we understand, I mean, it's kind of self-explanatory. It is your tolerance to risk. Well, what the heck is risk? Risk is effectively what the potential loss is relative to the potential gain. And your risk tolerance is different for every single individual. It basically means how much of a loss can I withstand in a given period of time to look for the potential gain. At what point do I become uncomfortable? And that is your tolerance point. And for every person, it's going to be different. You know, somebody might say, hey, if I give you, would you rather have $100 today with an additional dollar every single day for the next month? Or would you rather have $50 today with a 60% probability of $300 by the end of the month? And, you know, it's really a how much of that uncertainty are you willing to take on or to hold for that potential gain? And so the less risk that you are comfortable with is the more conservative your investments are going to be. And for somebody just starting out, I would recommend starting with a lower risk tolerance, and it's a trial and error effort. So you're going to take on a certain amount of risk, and you're going to either be comfortable or you're going to be uncomfortable. Now, I tend to be a little bit more on the conservative side, so I would err on the side of taking on less risk and then increasing that risk exposure until it starts to become uncomfortable and then maybe back off a little bit. And that's going to help zero you in on your risk tolerance level. Now, I would say that risk tolerance can really be grouped into two aspects of risk, or two aspects of uncomfortableness that you might experience. The first one is the mental aspect, and this is probably the most difficult one to deal with, the most difficult one to quantify. This is how something makes you feel. This is very difficult to measure objectively. The best way that I tend to try to equate it is, are you going to lose sleep over it? If you thought about, hey, if I took $1,000 and I lost $300 of it tonight, how are you going to sleep knowing that you have lost $300 out of your $1,000? If that gives you uneasy feeling, if that makes you uncomfortable, then that is beyond your risk tolerance. If you think about that and say, oh yeah, that's no big deal because I know, I'll probably make it back in another year, another 2 years. And that's cool. That's what this is all about. Then that is within your risk tolerance. And this is really where I find most people are going to struggle with this, because they tend to underestimate their ability for the tolerance. And so they think they're a lot more tolerant until they get into that situation. Mike Tyson was very famous in saying, hey, everybody's got a plan until you get punched in the face. And that's really where you start to understand and start to feel what that risk tolerance is for you on that mental level. Now, the other piece is what I call the practical aspect of it. Now, this is a much easier way to measure. And this is really around, when do you need the money? So one of the aspects of the risk is, what is the time horizon that the risk is on the table? Because remember, the risk is the loss of a particular amount of money for the potential profit down the road. And so, for example, if you need to withdraw $100 tomorrow, you probably shouldn't enter into a position where the risk or the uncertainty or the payback period will not allow you to withdraw that $100 tomorrow. So this is a lot more easy to quantify objectively, because you can take a look at the particular upcoming risk and you can understand, if I needed to bail out of this particular trade, of this particular investment, would I have enough money to cover what I actually need to that money for within whatever period of time that is. And so this is also important to understand, because you don't want to enter into trades that are going to lock up your money, investments that are going to lock up your funds with the ability or inability to pull that money out because the risk isn't done. The investment hasn't panned out yet. And so understanding your time horizon is very important when it comes to this aspect of risk. So that brings us to the end of episode number 1 of our mini series on investing. This should hopefully give you some introspection where you need to think about, what is the thing that you're saving for? What is that time horizon? What are the risk levels that make you comfortable or uncomfortable? And all of these things, we're going to touch on them again in future episodes, and it's going to start giving more color to the outline that we have laid out here. But the real important thing is just get started. So we talked about the different type of accounts that are out there. And if you take what your saving objectives are, what your time horizon are, and you think about the different types of accounts that you can hold, you'll zero in on which account you want to start with. And the first thing is that take that first step in the journey. Every journey starts with a single step, and that first step is going to be go open an account. And my recommendation is going to be go to Fidelity, go to Charles Schwab, open one of those. Go to their website, say open an account, and whichever one is the right type for your investment goals and your time horizon, open that. If you have multiple objective goals and multiple time horizons, maybe open both. Maybe open an IRA and a regular brokerage account, because maybe you have savings for upcoming house, upcoming car, and retirement, and you want to do both of them. open both of those accounts. Like I said, opening these accounts is as simple as any other online account for any other service that's out there. It is drop dead simple. So pick one of those, open it up, because as we touch on future episodes, we're going to start doing stuff in those accounts. We're going to start having you go purchase certain funds, understanding how you're going to do your research. And you're going to want to have that tangible account to work in to kind of investigate potential choices and things as we build on this series. So hopefully you found episode 1 enlightening. Episode 2 will be coming out next week. So good luck out there. Have fun. And remember, think outside the block.